There's a lot of uncertainty. So you buy them with low expectations built in, and if they do a little better or a lot better, you have the chance for asymmetric returns on the upside. And those are precisely the stocks that institutional managers who worry about doing well in the next year or two systematically avoid and overcompensate for that because they don't want to be there. So if there's uncertainty about the business, or you kind of know it's not going to be as good in the next year or two, institutional investors systematically avoid those stocks. You don't pay a lot for anything. So if they do a little better or a lot better, you have a chance for asymmetric returns. If the low expectations come in, you didn't pay for high expectations. So hopefully you don't lose very much. So if you don't lose very much on the companies where the good news doesn't get a little bit, the news doesn't get a little better than expectations, and you make a lot on the companies where it's a little better or a lot better, on a surprise, you can end up making a lot of money, and it's very systematic, and those factors have actually gotten stronger because of the institutional bias now in the market.
Now, as you know, sometimes even though you do brilliant analysis, a stock can still become a dog and stay a dog. Yet you say you get a better return with relatively handful of securities, 20 to 30. Yet you also have a fund where you can offer much more, but you get less of a yield. Why would 20 or 30 do better than, say, 500?
Okay, well, we really think of it as underwriting this systematic risk that people are avoiding this stock. So if you insure 1,000 lives next year, you probably could take a pretty good guess that about, just pick a number, 6% aren't going to make it through the following year, and you can underwrite that risk. It might be 5.8%, it might be 6.3%, but you can pretty well guess what that number is going to be. When you underwrite 100 lives, one or two guys going one way or the other could give you a different outlook. Now, over a 10-year period, and you can actually do a little better underwriting with those 100 lives. You can not insure some and insure others, and maybe do. But still, 2 or 3 or 4 people going the wrong way in any particular year can really change your results and your expectations. So we look at it the same way as stock investing. With a more concentrated portfolio, over time you can probably make 2 or 3 points more a year, but you probably have to wait around 5 or 10 years for those extra 2 or 3 points, and in the interim, it's going to be a very volatile ride. We can actually do it with 500 or 800 stocks with much less volatility. We do 2 or 3 points less, still beating the market by 600 or 700 basis points a year. But the key is, what will you stick with? Most people can't live with the volatility. When they underperform for a year or two, they leave. So if you know yourself and you truly have a 10-year horizon, it may be a better bet to take the more selected portfolio. We actually have a mutual fund that has a more selected approach. But it's really for people who are a little bit braver, meaning they understand what we're doing. We're buying above average companies, but only when they're available below average prices, and that makes sense to them, and they're willing to stick it out for 5 or 10 years. Most people aren't like that. Most people would rather have a bit of a smoother ride, give up a point or two in return, still with excellent returns, and take a more diversified approach. So there's something for everybody. They both make sense. The trade-off between the extra risk you're taking, which I don't
So
even...
you have 4 relatively new funds today. One, in effect, your version of a domestic index, your version of an international index. Somebody said that's not index, that's quanting. You say you don't care. It's the principle that counts. You have 2 other funds that are more of a roller coaster, or could be more of a roller coaster.
A little bit more of a roller coaster, but yes, they have between 75 and 100 stocks in general. Excuse me. So we have international and domestic index-like funds, and then we have international and domestic more select funds with 75 to 100 stocks in general.
And you make the point that, at least last thing I read was, your domestic is doing better than the market, your international is underperforming, and you say, well, that's what the real world is like. You're going to have periods of underperformance.
That's exactly how it works. If we had a strategy, and I wrote books about it, that worked every day and every month and every year.
Bernie Madoff.
Exactly. Everyone would do it, and everyone did do it, and it's not real. It doesn't happen. So we're long-term investing. It doesn't work every day, every month, and every year. Most people can't stick with it. I totally admit that. But that's why it works. And so what I spend my time doing in the books is explaining why it works.
Now, the last time we met, you said your way of trying to get value does not work with financials and utilities. Do you think you've found a way to do those 2 industries now?
Oh, that's a great question. Thanks for asking it. We did, for our indexes, we do now include both utilities and financials. We developed our own methodology for valuing those, and we insert them into our broad indexes for the company. So the domestic index does include financials and utilities. We do not include financials still internationally because of all the different standards where banks are regulated all across the globe, and there is some trickiness to the black box nature of what is exactly in those bank portfolios that we don't feel comfortable internationally doing yet. That's another project for down the road. But domestically, we feel very good about the regulatory.
Now, are international statistics other than financials something you can rely on now?
That's also a very good question. I appreciate you asking it. There are many databases that purport to follow international companies. We've looked at them all. We are not comfortable using any of them. The data is not anywhere nearly as good as what's available domestically, and we do our own database domestically also, but internationally it's almost impossible to invest with the commercially available data. And so we ended up putting together an investment team that actually created our own database for international, and we've homogenized 26 countries now with the way that we look at cash flow, the way that we look at valuation of companies and returns on capital, and we do that work ourselves. And so I think that's something very unique. And even though our select international is underperforming